disinflation process in the UK economy has continued. UK inflation was 2.6% in the latest data for March. That's above our 2% target, but it's a little bit lower than expected. So with the progress we have made, we can take another step in making monetary policy less restrictive. So today we've cut bank rate by 0.25 percentage points to 4.25%. As the past few weeks demonstrate, the global economic environment remains an uncertain one. Interest rates are not on autopilot. They cannot be. Instead, the MPC must continue to respond carefully to the evolving economic circumstances and the outlook for inflation in the UK. Whatever happens, the MPC will continue to set bank rate to ensure that inflation returns sustainably to the 2% target in the medium term. I'll return to the global economy shortly, but I will start with and spend most of my time on what is happening in the UK economy. That is ultimately what matters for UK inflation and monetary policy. And I will have 4 key messages reflecting our 4 key judgments on the outlook, before concluding with the uncertainties we face and the implications for monetary policy, and a few words on the prospects we see for a trade agreement. My first key message is that disinflation in domestic price and wage pressures is continuing. While headline inflation is expected to rise in the near term, we do not expect that to persist. Chart 1, which has just come up, shows the development of 12-month consumer price inflation since 2021, that's the white line, along with its components. As the chart shows, headline inflation has been around the 2% target over the past year, albeit slightly above on average. In the shaded area, the chart shows how we expect headline inflation to rise to 3.5% in the coming months. That's a little less than we projected in February, and we expect that increase to be temporary. Now, chart 2 illustrates why that's the case. It shows that the expected increase in inflation is driven mostly by energy prices, now in yellow, on that chart that is, and besides that by increases in regulated water bills, that's the purple bars, index bills for services such as broadband and mobile phones, that's the orange bars, and higher national insurance contributions, they're shown in light blue. These price increases are not directly linked to the underlying cost pressures in the UK economy. We should not expect them to persist. Meanwhile, other services prices, the darker blue bars, those that are more closely linked to activity and cost pressures, are on course to pull down on inflation in the coming months. As the effects of volatile energy prices and indexed and regulated price changes pass through, it's not least the path for these other services prices that will determine headline inflation. And the path for services inflation points to a continued gradual easing of inflationary pressure in the UK economy. And this is shown in chart 3. While their levels remain elevated, measures of underlying services price inflation have continued to diminish. This has happened as pressures from non-labour input costs have faded. So persistence in wage growth is now the main driver of continued high levels of services price inflation. My second key message is that a small margin of slack has opened up in the UK economy, and we expect it to widen over the next couple of years. Heightened uncertainty, weak productivity growth, and the continued restrictive stance of monetary policy have all been weighing on GDP growth recently. Businesses have been cautious about investing. That's the message we're getting. And while real household incomes have risen quite strongly, consumption has not followed suit. This weakness in demand has coincided with continued weakness in the potential supply capacity of the UK economy. Productivity growth has been weak. Nevertheless, labour market developments, survey indicators of capacity utilisation and statistical estimates all suggest that weaker demand has led to a small margin of economic slack opening up. Looking through data volatility, we expect underlying GDP growth to remain subdued in the near term before economic activity starts to pick up later this year as household spending and business investment recover, supported by a downward path for interest rates. We expect housing investment to strengthen too. Assuming potential productivity recovers some of its recent weakness, that pickup in GDP growth will still probably go hand in hand with a wider margin of slack. This takes me to the third key message. An emerging margin of slack in the UK economy should act against any remaining persistence in domestic wage and price setting to return inflation to the 2% target sustainably. A normalisation in wage growth is particularly important to ensure that services price inflation continues to fall back to levels consistent with the 2% target for headline consumer price inflation. Now, this process has still some way to go. Annual private sector regular average weekly earnings growth was 5.9% in the 3 months to February, having risen in the second half of last year. Now, that level in February was slightly lower than we'd expected in the last monetary policy report, however. And as chart 4 shows, underlying measures, estimated by the bank staff, have been more stable and point to a slightly lower rate of wage growth. And as we look ahead over the course of this year, we expect wage growth to moderate with a loosening in labour market conditions. This is supported by forward-looking indicators. The bank's latest decision-maker panel survey suggests that wage growth will be about 4% for the year ahead. That's the yellow diamond on this chart. And the bank's agents point to average pay rises for 2025 be between 3.5% and 4%. That's the purple diamond. With a continued easing in labour as well as non-labour costs, further declines in services price inflation will support a gradual return of headline inflation to the target as we look beyond the near-term increase. Now, as shown in chart 5 here, in our baseline projection, conditional on the market-implied path for bank rate, inflation gradually falls from later this year to reach around the 2% target within 2 years' time. My fourth key message is about the global economy. New tariffs and elevated trade policy uncertainty weigh on global activity. We expect global trade prices to be materially weaker, particularly in China. The US administration has made a series of announcements with significant changes to tariff policies. Some of its trade partners have responded. Volatility in financial markets has accompanied these announcements. Slower growth in the global economy is likely to reduce the demand for our exports and impact economic activity here in the UK. That reduction in external demand will also work to reduce inflationary pressures in the economy. But while the impact of what we have seen so far is likely to push inflation down somewhat, the overall impact on inflation remains uncertain. On the one hand, lower US demand for global exports, particularly from China, could lead to lower global export prices and hence lower prices in the UK, reducing inflationary pressure further. On the other hand, higher costs in the global supply chain, as intermediate inputs are subjected to tariffs or because of disruptions, could push up on prices. And while sterling has appreciated in recent weeks, easing inflationary pressures, global exchange rates can shift in response to trade policy news and the evolution of global risk sentiment. Although they understandably dominate the headlines, it's important to remember that global trade policies and how they affect the UK economy is only one source of risk to the outlook for inflation in the UK. Let me say just a word about the news, obviously, that has been coming out in the last few hours about the prospects of a US-UK trade agreement. We obviously follow this very closely. We haven't been briefed, so I'm speaking without knowing the content of the agreement, just to make that clear. That's as I would expect. But we do now have news that suggests there will be an announcement, and we welcome that news. I very much welcome it, and I think it's very well done to those involved. And the reason for saying that is that it will help to reduce uncertainty, and that's important, as you will see in the context of what we've said today. The UK is, though, a very open economy. So the UK is also affected by the way in which trade policy and tariffs affect, obviously, other economies. That is, in other words, the tariff measures that have been taken in respect of other economies. So I say that because I hope the UK agreement, if it is indeed announced this afternoon, will be the first of many. This will be good news all round, including for the UK economy.
Hello and welcome to Global Business Insights, where we look closer at headlines moving markets to equip viewers with perspectives to help navigate the business environment. That was the Bank of England, Andrew Bailey, the governor, as was expected, announcing another 25 basis points interest rate cut to 4.25%. The governor said interest rates are not on autopilot, but acknowledged disinflation in domestic prices and wage pressure is continuing, still slowing inflation, which fell from 2.8% year-on-year in February to 2.6% in March, has allowed the bank to lower interest rates, though Bailey reiterated the need for caution, warning that the global economy remains unpredictable. Bailey welcomed the UK-US trade agreement, which was announced later in the day, adding that this helps to reduce uncertainty. The decision revealed a notable split, with 2 members favoring 50 basis points interest rate reduction, 2 members voting to keep rates unchanged. 5 members voted to cut rates by 25 basis points. The pound sterling rebounded strongly against its peers after the announcement. U.S. Department of Labor reported yesterday that U.S. citizens filing new applications for unemployment insurance dropped to 228,000 for the week ending May 3. This was below initial estimates and was lower than the previous week's unrevised tally of 241,000. U.S. stocks rose after Donald Trump announced the first major agreement with the UK. Trump, that's America's president, and Keir Starmer, Britain's prime minister, announced a trade deal which Trump claimed would raise $6 billion from a 10% tariff on many imports from Britain and expand export opportunities for American farmers, though the deal removes the 25% tariff on UK steel and aluminium and immediately cuts the rate on most car exports from 27.5% to 10%. A lower car rate applies to the first 100,000 vehicles exported from the UK to the US each year. 101,000 were exported last year. In return, the UK government removes the tariff on ethanol for US goods and agrees reciprocal market access on beef. No change to the UK's 2% digital services tax on US firms in this deal, despite reports that this would be addressed. The deal includes fast-tracking American goods through UK customs processes, and Howard Lutnick, America's Commerce Secretary, also boasted of a $10 billion order of Boeing aircraft by British Airline. The final details are still being written up, and most agree that the deal is indeed sparse in coverage. Already reactions are mixed, with many saying the deal is not a trade deal. It's not 600 pages. It's perhaps faster to craft and maybe the model for future bilateral and more flexible and focused pacts, easier to agree and perhaps easier to break, and leaving out controversial themes as well. We could still have parliamentary and legal roadblocks despite the narrow scope, and it may still be months before a document that can be signed is ready. You could call the deal with the UK a quick win. It also sets the tone, but now the hard part, that is this weekend in Geneva as China comes to the table. Asia-Pacific markets were mixed as investors considered China's latest April trade data. Exports climbed 8.1% year-on-year in April, despite shipments to America down by 21% due to US tariffs. China exports to Southeast Asia up 21% and to the EU up 8%. Bitcoin prices also passed the $100,000 mark for the first time in 3 months yesterday, cementing revival of a risk-on attitude. That's all on this edition of Global Business Insights. Enjoy your weekend. Thanks for watching. Bye-bye.